Well, welcome back, traders. Today is January the 3rd, 2023. First trading day of a new year. Time to get rid of old habits. All of our P&Ls reset for the year. It's a good time to make those new year trading resolutions, risk management, position sizing, the things that we chat about every single day. But it is a new week and a new year, and hopefully a return back to some of the volume and the volatility that we've been lacking through this holiday period. It's really amazing how much success we have had in the last 2 weeks based on what the market has given us. Last week, of course, not only did we do 7 zero DTEs, but every single one of them was not only successful, but very successful from an ROI standpoint. I don't know how we pulled that out, but hopefully we get a little bit better action going forward here and we get some volume picking up on us. Let's go ahead and take a look at some of the numbers. That I look at as we get ready to start our trading week in our live trading room. We do use a overall matrix here of kind of what's happening in the marketplace via 12 or so different technical indicators. We use a dual overlay of moving averages all the way from 5 out to 200 days. And we look at the pivot point areas, which are going to be, I think, critical for us today as we get started. Now, one of the things that I think is interesting is that we're still in sell mode. We're still in a sell mode in terms of all of our technical indicators, but we're starting to see some green shoots, and we've been in a consolidation mode now in this market for quite some time. And I talk about this all the time. There's only 2 markets. Look, as traders, we don't care if the market's going up or down. So for us, really, the 2 markets are consolidating markets and expanding markets. And we've been in a consolidating market for quite some time. And while we never know, and we never even try to predict where the future moves are going to take us in the marketplace, one thing that we know and can almost guarantee 100% of the time, consolidating markets lead to expanding markets and vice versa. This is a market that is right now primed to get ready to move. It is primed for a decent size move. Will it be up or down? Well, we don't know, but the key thing is to be prepared for it. So this could change in as much as a 2 to 3 day trading period, depending on the vector of the move. But we could move from a strong sell signal technically to a strong buy again in 2 or 3 days if we get a decent size move. Futures are up a little bit right now, about 14 points on the morning as I'm talking here Tuesday morning, once again into a shortened holiday week with Monday, of course, being celebrated as New Year's. We look at some support resistance levels. These are some of the key areas that I'm seeing in the marketplace. And this is this black line right here, this 3840 level. It's what I have been referring to for quite some time, back until the summer of last year, July of last year, as the cliff. This is an area that we look at as a demarcation point. It's been a launching pad for the marketplace. It's been a jumping off point for the marketplace as well. And wouldn't you know it, we're kind of sitting right back in that area once again. So again, we talk about this consolidation here that has been taking place in the marketplace for the last several weeks. That never lasts. That will expand at some point. And I think this is a level, this is a launching pad for a decent sized move. Sometimes you consolidated an area and there's so much gamma or open interest at certain levels just above or below that you're like, okay, we're going to get an expansion type move, but it's going to be maybe limited in certain senses. I don't get the sense of that in this case. I do believe that we could have a decent sized move off of this level, but that's what we're looking for, and that's what we're being primed for. Now, the 2-hour candlestick draws us down into a little bit more substantive levels, and I put some Fibonacci levels on here as well as some support resistance lines, as you can see. And again, you can see that really going back to the third week of last year, the third week of December, we've just kind of been in this chop zone. We've just been in this chop zone right in here. And for me, some of the levels that I'm looking at here on resistance, whoops, there we go. On resistance, the areas of importance for me would, of course, be right above where we're at right now, up at 3,900. 3,900 is a big level, and then 3,920 above that, 3,931 above that, 3,955 above that, 3,991, and then of course the big one. The big one is 4,000. There is a huge gamma wall up here around this 4,000 level. But those would be the areas as we're starting off today that I would look at. Again, my slant is a little bit bullish here. You're going to take a look in just a second here at some of the market internals, and I do see some green shoots starting to appear here. And does that mean that we're going to have a big push to the upside? I don't know, but right now leaning slightly to the bullish side as we start today. Okay, support levels down below. What I would be looking at on a support level is 38.78, which wouldn't you know, right now as I speak, we are sitting at 3878.75. This is a big level right here, I think, as we start off the day. If we don't dip back below 38.78, my slightly bullish stance becomes a little stronger. If we can dip back below 38.78, now it's the bears are starting to try to grab a hold of this market once again. So 38.78, that's a pretty big demarcation point for me right there. I would stay really on top of that number. Again, I think it's interesting that we're sitting literally right on it right now as I'm speaking, 2 hours prior to the cash markets opening up. Below 38.78 is 38.57 and then 38.40. This is the cliff right here, 38.40. That's the demarcation point right here. That's a huge level. Below 38.40 is 38.20, and below 38.20 we start to get right down into this area right in here of 38.03. And you know, if the bears can break back below 38.03, they just, nothing changes. They're still in charge. We're looking to push lower. So those are the numbers that I'm looking at as support resistance areas for us today as we get started, primarily with our 0 DTE trade for the day, but also with our 4-day to expiration trades as well. We look at the overall market in terms of indices. And for those of you that aren't part of our live trading room, we actually trade each one of these. We trade the SPY, we trade the Qs, we trade the IWM, we trade the diamonds on a weekly basis. And again, a lot of people will say, man, why would you trade one? Why would you trade all of them? There are divergences amongst these indices. And you can see, again, the overall downtrend pretty firmly in place. The industrials had absolutely just gone on a tear. That has sort of mitigated the latter part of November, the first week or so of December of last year, and you start to see that starting to come back in line as well. And then again, you've seen some volatility in the Russell, heavily influenced by interest rates. Micro-cap stocks, very interest rate sensitive. So we have seen some volatility in the IWM. But if you use this chart, these are daily candles, and you pull back a little bit, I think you can just have to agree with me that we're still in a bearish market. We're still in a downtrend. Will that change? You know, we had certainly tried, right? There was a big breakout there in the IWM of our downtrend, and of course there was a breakout in the DIAs as well. Both the major markets, the S&P as well as the Qs, certainly tried. They certainly tried, but they were not able to succeed at that. So right now, the overall trend is still down. We look at earnings for this week, and it's a fairly light week. Again, we have a shortened week with the holiday on Monday. And there's not really a lot going on with earnings. There's obviously a lot of companies reporting earnings this week, but there's only one that I am really interested in, and it happens to be on Thursday, and it's RPM. I am by nature a trader and not an investor, but one of my long-term holdings, and when I say long-term holdings, I'm talking 1995. 1995 is when I started to build a position in RPM. It's a company that I very much like, and I might be looking for us in our live trading room on Thursday to be putting an RPM trade together. So we'll take a look at that as the week progresses and see where we're at. Now, sector rotation, this is what I was referring to just a moment ago. We are finally starting to see some green shoots that are taking place here in the marketplace. It has just been nothing but a sea of red for a really long time. And I think that we're finally starting to see some buying coming into this market. So we'll see if that takes hold today. You know, there are psychological levels, you know, oil at $100, the S&P 500 at a nice round number, 3,000, 4,000, 5,000. There are some psychological levels in the marketplace. There are also some, I think, key areas in the marketplace when you start to look at a change or a rotation in what we're seeing in the market. And one of those is January, the start of a new year. Sometimes just the fact that we get into a new calendar year sounds crazy, but sometimes just the fact that we're starting fresh, we're starting with a new calendar year, can change the perspective on certain areas as you start to change the outlook going forward. Heavens knows that was certainly the case last year as we went from a pretty darn bullish market in 2021 to a bearish market in 2022. Will we have that same effect in 2023? Will the market dynamics change in this month and shoot us back up to a bullish stance? I don't know, but I am, for the first time, as I said, in a while, starting to see some green shoots appear. And again, we are, you know, as I speak right now, up 18 points on the futures. So today, at least, it does look like a bullish stance. Now, last week I was out of town, I was up in the mountains, so I don't have a back-to-back week comparison here. This is just simply last week's. That's a pretty healthy week right there. For a down week, that's a pretty healthy week. And that's what you would like to see, generally speaking. You want to see all green. You don't want to see all red, because those are extremes, and extremes never last. So again, this is something that as I look at the overall sectors in the marketplace, I'm like, maybe we're going to get some strength going into this new year. We look at last week's results, and again, I think you can see why it's important that we trade all of these major indices, because they do interact with one another, but they also converge and diverge. And so we use a unique strategy. We have a 4-day to expiration trade that we use on both the SPY and the Qs. So we view these as one trade. Even though they're obviously separate trades with separate ticker symbols and separate setups, we trade those as sort of a symbiotic pair. We have a unique trading strategy that we use with the IWM that didn't have a single solitary losing trade last year. That's a big bar to set. I don't think, and I don't even plan on that happening for us this year, but it's a very unique and special strategy. And then we also have a very nice strategy with the DIAs that, by the way, this strategy was very close to 50% APR for last year's results overall. And we were over 100% APR on our DIA strategy last year. Still working on the performance review videos for the SPY and the Qs. Those should be out over the next few days. But it's important that you trade them all. Proper diversification. Put call ratio, not a big change here. You can see that it hasn't really given us much of an indicator. When it's above 1, meaning when put volume exceeds call volume, that can be an indicator. When it's below 1, meaning call volume exceeds put volume, it can be an indicator. It's just a market sentiment gauge. It tells us whether the market is extremely bullish or extremely bearish. And right now, we're just sitting at about 1.16. Not really too much data to draw out of this. And again, I think it's reflective of a market that has been consolidating for a while and is starting to look for its next big move. We look at the expected moves, talking about moves. We look at the expected moves in the marketplace. This is when I say, last week, we absolutely killed it. We were 7 for 7 on our 0 DTE trades. And, they weren't small percentage gains. They were big gains. They were upwards of 10%, 9%, 7% ROIs. It's amazing how we pulled that off. I don't know how we were able to do that with a market that had such a small expected move and correspondingly small premiums. We're not much better this week, folks. We talked over and over and over again last year when we were around a 140 point expected moves on the week to just enjoy the salad days. That's what we said. Just enjoy it while it lasts, because it's not always going to last. And sure enough, it hasn't lasted. Now, maybe we get something. Maybe we get a geopolitical event or something that can pump some volatility back into the marketplace. But right now, it's pretty low. 84 points is the expected move for the S&P for this week. Okay. We look at the fear, greed, sentiment reading. And again, that's a sentiment reading. It is a contrarian indicator. When, everybody's jumping out of windows, that's probably the time to buy. When everybody and their dog, when the person that is mowing your lawn is talking about their stock picks and everybody is really greedy, that's probably the time to sell. We are heading a little bit into that fear category where it probably makes sense to start looking for some long positions. I wouldn't say that the market is tremendously oversold here, but I do, again, sort of have a leaning bias, slight leaning bias here as we start the new year to the bullish side. So fear and greed index, we look at open interest levels, and I think you can probably tell where the market is focused, and that is that 4,000 to 4,007 area. That's a big demarcation point. But we've got some activity down at 39.55 as well. It's about 70 points, 80 points above where we're at right now. We've got some activity at the 3,900 level. That's only 20 points ahead of where we are right now. And then at the 3850 level, this is starting to get into and correspond right here with what we call the cliff, that wall, that demarcation point that has gone back to the summer of last year. And then, of course, again, down around the 3,800 level. So these are all very big levels of gamma. There's a lot of open interest sitting at those levels, and they can act as a magnet in the marketplace to suck that move into those areas. So we'll keep an eye on those specific areas. As you can imagine, those levels that I've just marked out right now correspond pretty darn closely to the support resistance lines that I've given you earlier here in this video. We look at the S&P volume. You know, volume is a big part of the equation. It's only a segment, it's only a part, but it's a big part of the overall recipe for getting IV, implied volatility, pumping into the market. And if you have low volume, you get more erratic moves. That's what we dealt with last week, was very erratic moves. And we're still not really seeing what we're looking for. If we could get up in this area again, I think you'd start to see some action, but it's been pretty staid. It's been pretty calm in terms of volume. We could use a little bit of a pump volume-wise here in the marketplace. We look at potential market-moving news for this week. Obviously, a shortened holiday week once again, which, by the way, it's been nice to have a day off over the last couple of weeks each week. But Tuesday, today, we've got U.S. manufacturing PMI numbers coming out. That could be a mover in the marketplace. Wednesday, we've got ISM manufacturing numbers. We've got the PMI. We've got JOLT job openings. And we get the release of the FOMC minutes. Now, this is not a Fed meeting or a Fed conference where Powell is speaking. It's just a release of the minutes. And that may or may not be a market mover for us. But we are prepared for that. And we do generally look to de-risk our model portfolio slightly by taking off some of our weekly trades, some of our shorter term trades. And then if the situation is beneficial for us, we'll add them back in after the Fed meeting. Thursday's a big day for us. Big day. Could be one of the biggest days of the month for us. Jobless claims numbers and services come out with the services PMI, but we get nat gas and oil inventory numbers. And both of those trades are a big trade for us. We are in an oil ladder trade that has been very successful for us. But we've also closed out 2022 with our nat gas trades about 50, if memory serves me correct, about 54% return on the year for our nat gas strategy. We're looking to open up our next nat gas trade. And this is going to be a big focus, probably going to be our number one focus for Thursday's trading session. See if we can get a new entry started in nat gas. Friday, we have unemployment rate numbers. We have non-farm payroll, non-farm payroll, usually a pretty good scalping catalyst. And so we'll see what we get out of that on Friday. Factory orders, month-over-month factory orders, and then quite a bit of Fed speak in the morning. Oh, by the way, Bullard speaks on Thursday. That's quite often a market mover. It doesn't have a lasting impact, but it does tend to move the markets. And then quite a bit of Fed speak going on in the morning on Friday. So those are some of the major news items that we'll be keeping an eye on as the week goes forward. Love to hear from you guys. Love to hear what you guys are trading. A couple things that I want to share with you. Number one is Happy New Year. I have had some great interactions with some of you over the holidays, and we've exchanged pleasantries, and it's really cool to get to know people, if only virtually, through this platform, through this unique thing that brings us all together, which is trading. So very happy and grateful for that as we start off the new year. And then the other thing, of course, is if you are not a member of our live trading room, couple things. Number one, you're watching this video right now on our YouTube channel. Make sure that you subscribe and hit the notifications bell. We have over a dozen and a half strategies that we employ consistently in our trading room. I've been trying to work diligently. This weekend threw me off a little bit because all I really did, it feels like, is snowblowed, sort of a record snowfall here in Utah. So I spent a lot of time with the snowblower this weekend and not with the computer. But I am diligently trying to get out our performance results for each one of these individual strategies. So number one, I would really encourage you to watch those. Number two is if you want to come into our trading room, check it out. You can do so for free. Come in for a week, hang out with us, ask questions, interact, talk with our other trading members. I think you'll find that it's the highest value trading room out there today. I really, really, truly do believe that. So come check us out. Let me know in the comment section if you have any questions. And we'll see you guys in the live trading room. My goodness, in about an hour and a half. So take care, guys. Talk to you soon.